What's going on, guys? Welcome into today's show. I've got Jonathan Tuttle, a seasoned real estate investor who actually grew up in a real estate family. And they were really early to the mobile home park space and then have transitioned over to flex space developments, even looking at data center opportunities, which you're going to hear about here. But really, what I appreciate and like about investors like Jonathan is they are really good at spotting trends and using kind of the science and the data to drive where they park their dollars next. Obviously, you're going to hear him talk about how they execute and the key critical components of having the right team, identifying the right model, the right strategy. But in this episode, we dove into a lot of those things in detail. And you're going to hear a little bit about Jonathan's family background and his early exposure to mobile home parks, which really kind of helped shape his investment philosophy that you're going to hear about today. We talked about why mobile home parks became one of the top performing asset classes. Is there still opportunity? Where do those opportunities exist today in the mobile home park space? He also shares his insights on why they like flex space industrial developments and opportunities and why they might be the next self-storage. We talk about the growing role of data centers and this early age of AI and how it's going to continue to expand. And obviously, I'm a big believer in spotting trends early, getting in early, and riding the wave and the craze as time goes on. And this is really what we both believe is happening right now in AI and specifically in data centers and how investors can think about positioning themselves for this future. We also talked about some practical lessons on raising capital, building strong teams, navigating today's interest rate environment, a whole bunch of other great stuff that will help make you a more informed and insightful investor when it comes to real estate. So whether you are an experienced investor looking for the next big play, or you're just curious about where real estate is heading, Jonathan has some great perspective that you're going to get a fresh look and hear from him on what he's doing to take advantage of the opportunities that are out there and around the corner in today's landscape. So grab your notebook. Let's dive into today's powerful conversation with Jonathan Tuttle. Jonathan Tuttle, welcome to the show, brother.
Thanks for having me on. I'm excited to be here. Thank you.
Anybody that's rocking a land play shirt obviously is flexing that they're in the real estate space, right?
Yeah, I just actually got the shirt today. And I was like, I hope it fits.
There you go. There you go. Well, for those that don't know about you, and I know you're in a variety of different kind of verticals within, real estate, commercial investment, finance. But bring us back to, what brought you into the space for why real estate. Obviously your entrepreneurial journey. Everybody's always got some cool inception story. Like, where'd yours begin?
Yeah, I just grew up with a real estate family. So my dad was a developer contractor, built 75 single family homes, like smaller mid-level range, single family. He eventually got into the mobile home park space around 2005. And so I kind of followed him along that realm and saw how that real estate did really, really well during the last downturn because everything else, if you're older, you can remember the chaos in 2008, 9, 10. And the mobile home parks were actually going up in value and it's still kind of relatively unique industry. And so I've always kind of followed, as we spoke before, I always kind of find like the alternatives to be more exciting than traditional asset classes. And so, yeah, just grew up in the real estate family. Then eventually, when I first started doing brokeraging, switched over to commercial real estate brokeraging. And then eventually I was like, you know what? I'm seeing the owners make. I'd rather be on the other end of this. That's where the real money is at. I mean, you can make good money in brokering, but the equity and like the exits are a lot bigger, obviously, if you're owning or developing real estate.
Yep, yep. Ownership is always the key, right? I mean, I think if you're somebody that's in an industry and you're able to, transact, that's great. But it's always the people who are on the ownership side, long term, that end up accumulating and building the most wealth. And 2005, man, I'm going back. I mean, uh, that was before mobile home parks really were like this sexy asset class, right? So like, I'm curious, like, back then, what brought your dad into the space and, how did he kind of scale what you guys have built into a really nice portfolio, it sounds like.
Yeah, I think, well, he wished he would gotten there before that because he had opportunities and some of those actually ended up becoming like really big assets because he was being a developer and contractor.
Yep.
He saw asset classes, but I think he saw there was, oh man, there was before. Mobile Home University, they actually bought the original course. It was like on CD-ROMs, like initial info course, and obviously everyone buys info courses now like courses nowadays are huge online, but
Yeah.
it's like a mobile home course by like some 7-year-old dudes back in the day on CD-ROMs, like, and yet literally put it in there and had like a accompanying like binder with all like just like terms and how to like flip, and that's what got him into it. And so he finds random things online. And that's kind of like, and I was like, and then when I got into that class, to your point, I like asked that class, hey, tell your friends. I'm like, oh, I'm gonna get my first mobile home park. This is back, 2008, 9, 10. Everyone,
Yeah.
yeah, it was my own. And my friends are like, what are you talking about? It's so weird, like mobile home parks.
Yeah.
Seeing them, I hear Eminem rap about them, but like, yeah. And so now, like you mentioned, like it's become the hot asset class. One of the hot asset classes.
Yeah.
That's kinda cooled down a little bit in the last couple of years because of, interest rates, but it had a nice run from, like, 17 to 22, 23, where it's just, like, Green Street data. I don't know if anybody knows the most institutional data. It was the top performing asset class, and then industrial is number 2, I think self-storage number 3, and so it's had a nice run for, like, the last 7 years, but the biggest thing with mobile home parks, it's just very scarce. There's only about 43,000, 44,000 approximate parks in the US, so that's what draws you into it, but also it helps kinda makes scaling a little hard at the same time, so.
Yeah. Yeah. Kind of like insulates your investment, but also makes, scaling the investment a little bit more challenging because obviously a lot of institutional capital got into the space between, what, 20 to really, I think it's still, relatively a highly desired asset class for a lot of obvious reasons. But maybe like from your perspective, break down what is it about mobile home parks that you guys like from a fundamental perspective and kind of just take us, through maybe the post-COVID era of, the journey that mobile home parks have been on.
Sure, yeah, I'm speaking at IMN Nashville. It's a manufacturing house in the East, one of the biggest conferences in regards to that, and also moderating actually a couple days from now, on Tuesday, August here, 2025, August 18th. But yeah, so we're that conference, for example, has mostly a lot of people coming into the asset class. So they kind of like a lot of PE, private equity guys come in there. And to your point, yeah, like the big groups, Apollo, all the big guys came in. I think originally around like 2015, 16, because the big reason it was because Warren Buffett was the biggest financier and also a developer, New Homes, the Clayton Homes. And then you also had Sam Zell, who's considered one of the greatest. He just passed away about 2 years ago. He's from Chicago, is where I'm from
The
too as
grave
well.
dancer.
Yeah, the Grave Dancer, considered one of the best real estate investors of all time. So you have two of the
Yes.
most highly regarded, successful investors, and they don't even work together. And they're talking about mobile home parks as one of the best asset classes. And so obviously the smart money, the private equity guys like to look up to who are the top guys and what they're doing. And that's what kind of got those people into the space. And we saw it coming because like back then I was brokering in 2015,
Okay.
right before that mobile home parks, and I could see like the natural transition. And you knew it was just a lot of these people developed these parks in the 70s, 80s. Some of it pre-HUD, so some of the designs don't even transfer over. So it was just like flipping the land and put it to higher and better use. But for the mobile home park owner, it was like big exit for the last few years. And right when you mentioned COVID, it was just chaotic because interest rates are so low. And then these baby boomers, people that developed these parks had for 30 years. Now their parks have like doubled basically. And so they're getting these astronomical numbers. They're like, wait, our parks are worth how much? And then you have the data because you also have the different brokers competing for it, and you have institutional people putting offers in at the same time. So it really drove up the prices in the parks. Like if you Google some of the search or ChatGPT, some of the searches and see like some of the exits, and like it was just astronomical growth. Because it was just it was just a perfect synergy, interest rates, market awareness, and timing, and people wanted, and at that time too, people wanted safe, alternative assets. So it was like everything, the perfect storm at the same time. The last couple of years, since the interest rates have changed, you still have the issue now we have a lot of the deals were bought up. Two, the owners that didn't sell have this mindset like, oh, hey, like you guys are telling me 3 years ago, like it's still interest rates. Well, yeah, but like if there's 5 people competing with it, like, can I get this? I'm like, no, because we can't. We're not paying cash for this deal. We're using
The
leverage.
modeling is
And
different now with a much
yeah,
higher
so their
interest rate,
mindset's
right?
still on that pricing because they didn't sell.
Yeah.
And then, so even if you talk, like when I go to this conference, and I remember the last time I spoke there 2 years ago, same sentiment. It was about the year because when interest rates first changed was 2023-ish. And the sentiment there was a lot of people that are operators are acquiring for less, 5 to 10 a year or 3 to 5 a year, and we're acquiring 0 1 because like the deals were so scarce. Um, and then the owners just it just didn't line. And to your point, with institutional guys grab the top asset classes and they buy at a price you can't compete with. Like you're not going to make money because they
Yep.
just access the capital way cheaper. And then you also have the stereotypical what mobile home parks, people's perception of it is like the trailer, what do you want to call it? But so you have like 25-30% of those parks you don't want to acquire either unless you want to do a complete turnaround and you're like really boots in the ground. You have good access to used homes or a team that can, like it just becomes like a really big headache. So trying to find that in between asset class, it's under institutional deals and also not complete full turnaround that's going to take 3 years and the
Yeah.
headaches. It just really keeps it like really scarce in the deals that you're actually quality to buy and acquire.
Yeah. Yeah. And it was one of those things too, I think for a lot of people, like affordable housing became more and more front and center with affordability housing crisis issues, right? And so people going, well, like I just closed on a little mobile home park a couple weeks back,
Nice.
and it was kind of a cool creative deal, 100% finance. I think I ended up total wiring, I think under it was like under 9 grand out of pocket for
Yeah,
the deal.
that's the deal is we have that one-on-one relationship that makes sense for sure. Yep.
Yeah, so and those get, they're few and far between, but when you get them, they're great. Um, but I remember talking with another guy out in Gillette, Wyoming, and he owns some mobile homes as well. And he goes,
Interesting.
you know, the mobile home parks will always have demand and insulation to the asset class because it's literally to say it, kindly, right? It's sometimes the last place people go before homelessness, right? And so it's one of those things where it's like there's always going to be a demand for affordable housing. And if you can do it right and operate it right, it's not only a great insulation of, your cash, but there's great yield on them and there's amazing cost seg and tax benefits. I think I wanna say mobile home parks are, like, number 1
Yeah,
in cost seg basis or
yeah,
cost seg depreciation, correct?
yeah, you're correct. Yeah,
And,
typically it's
so,
27, it's
from that
15 for parks.
perspective, it kinda checks a ton of different boxes from an institutional level, from a, kinda mid-tier family office or private equity level, from a, mom and pop level, right?
Yeah, exactly. And to your point, for the cost segregation, it's 27.5, 39 traditional commercial real estate, 27.5 for multifamily, it's 15 for the land improvements. And then you can also break it down, like if you had a cost, survey, they'll come and say, hey, 5, 7, 10 years for certain, furniture and things of that nature. But the bulk of it's going to be the land improvements. So it's about 70-80% of a park could be bulk of it could be written off. And so like that was the big thing for people for the tax benefits alone. It's like those little secrets. And like I remember I used to advertise and put ads like, "Oh, 15 years appreciation plan." I'm like, "No, this is impossible," because people like,
I
"Talk
don't
to a
know.
cost segregation guy." Like, I know they're actually one of the biggest guys in the country. And now with the new big bill, just as this, this comes out, they're gonna. I think it's not going to be changed. Like the cost seg is going to be set in stone because they remember they were trying to phase out
Yeah.
certain aspects of it, and then
Yep.
when Trump get back in, I think I know. Don't quote me 100% on this, but I just saw some stuff on Twitter. I don't know. Do your due diligence, but I think they
Yeah.
said that's going to be still
DYOR,
good.
right?
I think it's going to be good with just they want to focus back on commercial real estate investment. So great time to be back into commercial real estate. I think that's what also picks up the economy. They want to see people investing in U.S. real estate because what happened for a while too, like people have money, they're going to chase returns, whether it's in the U.S. or it's other countries. So in
Yep.
a lot of other countries now, if you're really wealthy, they're giving like really advantaged like second passports and like really like people know about Dubai with the uh, Puerto Rico has a tax code, 64% capital gains or 0% capital gains, 4% real tax,
Mhm.
income tax. And you have like some of these other countries like Dubai, or UAE, where it's like, I don't know exactly, I think they just changed, but I think it's 9%. So if you have money, you're going to be chasing yield. And so Trump came back in and is like, no, we want to keep this money back in the US.
Yep.
So it's been good to be an investor in a commercial real estate in the US again.
Yeah, 100%. I think, obviously, too late, Jerome Powell, according to Trump, is
Yeah, they
obviously
should have got
pushing
rid of him a
for
long time ago.
he's pushing for rate cuts. And I see both sides of it, right? I mean, I understand the challenges of, you don't want to start cutting too soon before, inflation feels like it's under control from the data sets that we've seen recently. I know CPI came out today. It was, cooler than expected, which was great. Or it was below expectations. I think it's at 2.7 or 2.8. Um, a lot of the data shows that we should be cutting, right?
Yeah.
And I think there's a lot of benefits that are going to come from that cutting, not only for the overall economy, but specifically for commercial real estate. What's your thoughts on how rate cuts and the impact of those rate cuts are going to, flow and trickle into the commercial real estate industry? And how are you looking at navigating the terrain as that happens, based on your guys' investment goals?
Sure. Yeah, great question. I'll break it down. So yeah, for even the sentiment, like when we go to the conference and we go to conferences and the big investors, when the rates low, obviously are better and more attractive, it makes for a lot more investment and people, investing. And so, when you're raising capital, it's like you can see different phases of like when people are really into the marketplace and capital raising is easy. And then you also go through loans where it's really hard. And I think right now we're kind of transitioning where, now we have, we're kind of seeing how the market's staying stable. And so the sentiments, like, I've talked to other people raising capital and, syndicating deals, and they're saying, okay, now we're starting to see investors for a while. Like in the last year, it was kind of like there's a hard time to raise capital.
Yeah, it was
And
stale.
even recently, too. So, like, you have to do 5 times as much work, whether you have to call family offices or make sure your tax like super on point. A lot of relationship building, a lot of conferences, a lot of podcasts like this.
Yeah.
Um, and so, yeah, once I think people are at a point now too, they've been sitting on the sidelines for a while. They're getting itchy to do something. So, like, obviously, it's better just acquire the deal, make it up long term, depending what your goals are. But like, it's always good to buy real estate if it's positioned right and you have the right team, you know how to like manage it correctly. And so I think a lot of people are kind of getting out of the sitting on the fence, actually taking action. I'll get some more feedback when I go to this conference, as I talk to some of the biggest operators in the MHP space. And one of
Yep.
my panels, the guy has 7,000 lots where I'm the moderator of. So I'm going to see what his kind of feedback is. You've probably had him on the podcast, but um, yeah, so I think if we get the rates, if Trump could pull some strings here to get the rates on the back end, that'd be great. But I think overall, I think we're starting to see a better sentiment. It's gonna be curious what 2026 is because for our space in the alternative asset classes has been pretty fine. It's the people that purchased. The biggest issue was people that purchased in 2020, 21, the low
Right.
rates with the idea of raising the rents to cover any, they did the short term loans, whatever it was, or they just did so the multifamily realm, and I have a multifamily group on Facebook. It's like one of the bigger ones. I like 29,000 people, and I see some of the feedback and I see some of the data. It's like there's a significant amount of those are like coming up. They're not going to be in the right position.
Yeah.
So
Yeah.
it's
I'm in a couple different mastermind groups, and I would say of all of the asset classes, while, obviously everybody knew multifamily was the hot ticket on
yeah,
the block from 20 to 22, with cap rates compressing down to fours and four and a
yeah,
halves. And, obviously a lot of the interest rate debt that people were getting, thinking that rents were going to continue rising and, there was going to be no cap rate expansion. It was just going to stay that way forever. Now the survive until 2025, became the theme from 23 as rates started going up to 25, thinking that they were going to make the cuts. Obviously, that didn't happen as quickly as many people thought. And that's the asset class across all of the assets that I've seen flip from being the hottest and sexiest and the most lucrative to being the one where a lot of syndicators are doing capital calls. Some of them are handing keys back. I've seen a lot of deals go total losses with sponsors that I would have like,
and
no way is that guy ever going to go belly up, or no way is his deals going to go sideways. And man, it, it, it just reminded me of like, there's a lot of good operators out there that didn't understand risk mitigation at the level that they should have when they were raising the amount of money that they were, and anybody can get caught in a market cycle. And there's so many different macroeconomic levers that can totally crush your deal. But at the same time, I think there's, so many lessons in that as well of like, you can't no matter how good and frothy a deal, a market is, you can't expect that music to continue to play forever. And if you don't mitigate your risk and you're only looking at, your pro forma modeling and underwriting through this rose-colored lens, like, you're really doing yourself and your investors a major disservice.
Yeah, no, 100%. I think, well, there's a couple of factors too, because at that time there was like courses coming. Everyone was selling courses when COVID, because I was staying at home, and I remember there was courses being launched. Just like everyone started raising capital, and some of the people didn't actually have significant real estate experience. At the same time, you also had, which I love Grant Cardone, but at the same time, like, oh, don't buy single family, buy like a apartment complex. And
100%.
then they probably this data outline line, like, oh, well, all I have to do is raise some capital, watch, a couple of videos, and they didn't have any real estate background before. They didn't go learn how to do due diligence. They didn't learn the different market cycles. And I think that was kind of fueled part of that too. And some of these people like literally had no real estate experience, but then saw on social media, like, hey, buy multi-unit, buy multifamily. Here's how to raise capital. Capital is abundant. Interest rates are low. And they just, that kind of, I think that
It
was
was
one of
kind
the
of the
big,
perfect
people
storm.
that, yeah, I think it was kind of to the, yeah, exactly. Perfect storm. There's a lot of people that, and I would see people raise money. I'm like, I look at the decks, I'm like, "These don't even, like, make sense." And when
Yeah,
people are handing them cash, hands are fed.
literally.
Wow, it's crazy.
Yeah, there were people raising money that shouldn't have been raising money.
Exactly. Ex
And, I've always said, like, it's easy to, model something sexy in a spreadsheet by moving a couple cells around and plugging this in and that in. But, like, when it comes to bringing that to life in real world scenarios, like, one, you better be rock solid as an operator. And two, like, you better hope that none of the headwinds that could have a probability of occurring don't occur. And that happened on many different fronts. Bad operators, all the headwinds, showed up, double whammy. Now all of a sudden you're, upside down a deal. Now, do you guys only invest in mobile home parks? Or I know you got your hands in a lot of different stuff. So, give me maybe the zoomed out look of mobile home parks is kind of like one of the core, verticals of your guys' investment. And do you guys have a fund or is it just all family?
Family in the parks, and then the fund in which, to your question, is into other alternatives, including flex-based development, it's primarily Texas, and also we're looking at data centers. As I alluded to before, is like, even all the, mobile home park operators, like, the biggest thing is finding quality deals, which you mentioned earlier, like,
Yep.
I so it's only a scarce amount of deals, and at the same time, if you're doing a fund or if you're raising capital, so, for example, family offices, they invest 72% approximately, data's not 100%, but, like, 70% plus in family office invest in multifamily, but very small percentage invest in mobile home parks, primarily due because of the size of the deals. They like the bigger deals. They think that gives them more.
Yep.
Uh, they like the bigger deals, and they also like bigger raises. They think that gives them more safety and security, but that's obviously not the case with what you just mentioned.
Right.
But that's their mindset. They're like bigger is better. But and a lot of the bigger operators too have also added other asset classes. Beer Brandon was a big podcaster. He started adding multifamily. I think he's doing self storage included. Another group is doing parking lots. Another group's doing self storage flex space. So as we've been in this space for a while, we see where the market trends because we've been in it for a long time. And so what are some of the other alternatives that kind of feel very similar? And flex space is very similar to like mobile home parks, 'cause you're basically renting space, but you have the flexibility of being. It's a quick turnaround, and right now it's underserved in the markets. And right now we're working in. Our partners have a few different, actually own the assets in Texas, and 8 or 9 of the time. I don't know what it is currently, but last year was 8 or 9 of the top fastest growing counties in America are Texas, and I think might be 8 now, but we have one on the second or third fastest, or first or second fastest growing corridor in between Austin and San Antonio on the major highway, I-35. And so I think that asset class is really attractive because it's quick turnaround time. It's not a 5-year hold. And it's very appealing, and it's resilient because it's just like it goes back to the mobile home parks. And that's my mindset is, what are people going to need long term? And what are things that are asset resilient? And the typical tenant for a flex space is typically HVAC plumbing, the jobs with a shortage of, and then those jobs don't get replaced by AI. So because they're not going to have like AI plumbers, not at least the next 10 years. Maybe they'll
Yeah.
have like Tesla have bots.
Never
Who
say
knows?
never.
But I don't think that's going to be. I think it's still going to be human touch for at least the next 10 years. So each HVAC plumbing service based businesses, maybe small e-com type store things that are drop shipping stuff from like Shopify and things of that nature. So flex space, and then the other asset class I really like, these are for like bigger investors. It'd be data centers. To the other point I just mentioned is AI. Well, the really, really big money, because I go to a lot of family office type conferences, and like the big money is going after the family offices and the big investors, the institutional wealth, excuse me, is going, and foreign wealth funds are going after data centers because they know they're looking at what is everything consumption, everyone's online, AI is tons of data. So like those storage centers, and what we're looking to do is like a subset of that where we're underneath, we've got to find our niche, and we're looking at old office buildings that could be reconverted to have the power. They're under the institutional deals. Like we just saw, if you Google, Mark Zuckerberg's building like a data center bigger than
Size
Manhattan,
of Manhattan,
or
yeah.
something
I
like
saw that,
that.
crazy.
Some like that's, and then Google's too. So well, that's not our niche. So our niche is finding like a building that's where the cities are going to basically bug us because they get the tax revenue. And so it's kind of like a really creative play on a property that needs, they want the tax revenue. It's, it's the abandoned building, and it also serves the need. And so family office will probably be our deal partners with that. We have a couple we're talking to. We've been looking at a couple deals. So yeah, between flex space and data centers, unique data centers, and then occasionally mobile park. It just comes down to finding the right deal. We mentioned like the one deal you had sounds tremendous. But those, like you said, are few and far between nowadays.
Yeah.
So you gotta kind of pivot that still aligns with the trends and safety security, but also where we could find our niche, and where we could find our way that's easiest path to success.
And are you guys, doing the ground up development on the flex
Yep,
space?
yep, yeah. So we have a team, pretty seasoned team down in Texas, local boots on the ground. Yeah, my partner on here recently too. He's the head of it. They have another developer who actually flipped one of the lands across adjacent to the Tesla Gigafactory. But he did it a little early, but he still saw the foresight of it. He was like, "Man, if I'd have kept another year, it would have been like even crazier." But he's been really good at getting sourcing deals for us that are like just because he's boots on the ground right outside of Austin. So we're getting some of the primest location deals. And it's a lot of relationship driven, like the one on our 35 deal. Like we could already turn around and sell it without doing anything to it, and probably make 1.3 profit on it, and just on the land.
Wow.
It's just because it's so prime, and now there's right across the street, they're building 10,000 homes behind it. The city and the government's putting 3.5 billion on the road. They're building, all national retailers coming in. There's $18 million Top Golf like a couple blocks away. Then they have like schools and everything else coming behind it. So it's like this, basically we just got the relationship driven, uh, got us these deals. And then we have contractors that built a lot of Walmarts in the area, and self storage as well. So we basically built like kind of an all-star team, and we're just kind of going to go where the trend is. And right now the hottest market's Texas, and it's pro business state. And
Yep.
so focus on that for a while.
I love that. I think one of the things that I've seen, so many successful investors do, obviously there's the tried and true strategies, right? That are, the boring, unsexy, but they're the steady eddies, right? That you can ride them off into the sunset, maybe not as opportunistic and, as much upside, but, still hitting singles and doubles long term. But then I've seen, people who have kind of like you guys, right? Of like the foresight to identify trends, be early adopters, really lean in on understanding the landscape, the risks, the opportunities, and then you position and kind of stake a thesis, a bet accordingly, and you execute on that plan. And sometimes it, does okay. Other times it crushes. And so I'm curious, like in terms of how do you look at that, of like, hey, we're kind of navigating, just data centers, right? Being one of those, like you, at least from all my research and the overall sentiment and trends and where, the darling of the market is AI, right? And it kind of feels like it's still extremely early. And when you talk about where AI is going, what the Trump administration is doing in terms of, what they want to be known for with being AI friendly, bringing energy back domestically, and, the opportunities that are there. Data feels like a good bet. Data centers feel like a good bet, right? And so how are you guys kind of like penetrating new opportunities, at the level that you are? Because I know for a lot of people, rather like, man, data centers sound nice, but how am I going to break into that space? So I'm just curious whether it's data centers, whether it's, the flex space that you guys are doing. Like, how are you guys going from theory and investment thesis to breaking into the space and executing and scaling into that?
Yeah, great question. Yeah, it mainly comes down to our team and being boots on the ground. So like, my partners, my role is more of like the marketing, the capital raising, and then I also speak at different conferences and have a lot of institutional partner like relationships. So that's my component.
Yep.
The the partners, we have the developer, the person that's sourcing the deals. We have a good lease, like the top one of the top leasing agents down there. And then Alex, my partner, he's like just experienced building multiple flex space deals. And so having the proper team that actually has their own ideal role, where they're actually the best at, and then sourcing the deals, why we're focused on Texas, we have a lot of really good, really strong relationships and a lot of deal flow that most people like that one deal, like we could turn the deal around just because we've been working on some of these deals for years to
Yeah.
actually have opportunities. So it's kind of like just basically timing and also having access to deals and the team. The data center is the play right there. It's a longer play and it's more complex. It's a lot more due diligence, and making sure like that we haven't done a deal with that yet, but we've been building a team with that too to get some experts to help with like the conversion side of it. But that aspect is kind of open new territory for everyone too at the same time. So we're all
Yeah.
kind of so it's not like an asset class that was around like
Yeah.
10,
We
15
weren't
years
talking
ago.
about
So
data
we're like
centers
all
10
new
years
as
ago,
long
right?
we're all learning together. The key thing is like the good thing is like with the tenets of that, like we know they're not going anywhere. And so you look at when I look at how I look at real estate, so I look for stuff where it just makes total logical sense and based on trends, dynamics, and then like we were talking about risk. Well, what is going to be, where are the trends going, and what is the worst case, and what are things that are just going to keep growing? We know AI is going to keep growing. We know that there's a huge need for plumbing, HVAC, and it's quick turnaround too, which I love about the flex space. It's a quick development. You could do, 18, 24 months, depending. 6 months gets it up and like fully developed, flipped in 2 years, which makes it really attractive. Um, I just like things where it's keeping ahead of the trends and there's still opportunity. Cause like the mobile home park space, there's a lot less opportunity. So even if you have a lot of relationships, I did an interview recently, a pretty big, a decent sized blog, and then a couple people shared it. It's like, yeah, other brokers, investors in the MHP space are like, yeah, the deals, it's getting scarce. It's getting
Hmm.
scarce. And so, whereas we knew that's happening anyway, we saw, because we've been in the space, boots on the ground for years, decades actually. And so you could see the movement. So, like, we could position, we'll wait for the right deal to come in. But in the meantime, we have relationships, we have boots on the ground in Texas, the fast growing markets. These are quick plays. And so, or at least the flex space are quick plays. And the data center is like a long term thing over the next 7, 10 years for the bigger deals.
Yeah.
So,
Yeah. I was watching, I don't know if, did you see that interview with, I forget what his name is, but the CEO of NVIDIA, was recently at a conference
no, but
and
I'm sure he was talking about that.
yeah, it was one of those he covered a lot of different topics. One, obviously the big conversation that a lot of people are having, right, is like AI is gonna eliminate jobs and, we're gonna go into this great recession and we're gonna be run by AI, robots and things like that. He's like, "Hold on, like let's take a step back. Let's zoom out. Let's look at all of the let's call it decades of disruptive innovation and what it has eliminated, and then as a result, what it has created."
Yeah.
And as a result of that disruption, and almost in every single scenario and circumstance he gave, it was a net positive to what upside it created versus what it eliminated. And he
Yeah.
said the same thing is going to happen with AI. Now, of course, yes, it's going to eliminate a lot of different jobs. It's going to transform industries and business and how we do things and, how the world, operates. But it's going to create so much opportunity and kind of, to put an exclamation point at the end of it, which I think it kind of summarized, in a simple way what the opportunity looks like. He said, the internet was about breaking into normalizing billions, and AI and data centers are going to break into and normalize trillions. And to me, like that was a little like, you more and more hear the word trillion getting thrown out there now, but still it just seems so crazy, right? And, a couple decades ago, the word billion was like, "Oh my gosh, that's crazy," right? So, to me, he goes, it's we feel like we're still in the first 10% of this opportunity in this journey. And so to think about, the like you say, right? Like follow institutional, follow the big boys and big girls who got the big balance sheets, who are placing bets into the future backed by a lot of data, a lot of research, a lot of intel. And when they're saying that kind of stuff, to me, it gets me excited about what the opportunities are in the future. And if you resist those opportunities, you're going to be the ones in 10 years going, man, I wish I would have, could have, that versus what you guys are doing, right? Is you're playing and thinking in terms of decades versus, you know, 6 to 12 months or a couple years. And so I always find that to be, a common theme and thread amongst, macro, big, long-term wealth builders. And would you say that you would agree with that, or how do you kind of look at the opportunities that are out
But if
there?
they use
And
that for our marketing.
yeah,
Yeah, no, 100%. And like, yeah, AI is incredible. I was kind of like, I've always been like, I have a digital agency like for 8 years, but yeah, incorporate AI components into it. But the fact is, like, the first thing was the first iteration, like when it first came out, ChatGPT, it was still like blockchain was like so hot topic then, and obviously crypto. And then they had this and then I saw some of the stuff being released. I'm like, oh yeah, it's not that great. It's like just like it's basically what it's been doing for now. And then now everything I do on chat, I'm like, okay, what do I like? I need a product and I'm gonna go on Amazon. I go on ChatGPT, like what's reviews? Or like I literally get the best intel. It replaces so many, like I'm traveling, I'm like, okay, what are the places I should know about that I didn't know about?
yep,
It gives you so much data. And you gotta think of like if you think of that for the average person, but the institutional people, they have even better data when they make a decision. So kind of follow, like to your point, follow what they're doing. If they're taking the best data sets available and making smart decisions and mitigating risk and looking at the long-term picture, you can do that for your same for your business. And that's kind of like what we feel like we're aligned with what's going on based on what you just mentioned. I'm gonna use that as a marketing clip. It
there you
sounds
go. Hey, take
but
take
like,
it,
yeah, you
take
gotta
it, and run
follow
with
what
it.
you gotta follow the institutional money. That's what initially got me into like, like we mentioned earlier was like and the big institutional investors follow the Warren Buffett, they follow the Sam Zells. And
Yeah,
so it's the same premise. And it's if you look at it logically, it's like, okay, like it makes sense. AI is not gonna be going anywhere. It's gonna go exponential growth in the next 10-year hockey puck growth.
yep,
And then we know flex space is like it's underserved right now. And so it reminds me of like flex space specifically reminds me of mobile home parks and self-storage 10, 12 years ago.
yeah,
Just kind of like getting out there. And then like this is the boom. And then 5, 10 years, like you mentioned, like 5, 10 years now, flex space probably won't be a thing because it'll be the market will be saturated and there'll be enough out there. And like it reminds me of flex space reminds me of self-storage and mobile home parks in early 2010s when it was
mm.
just kind of where the market's like it seems like it's gonna be a fit and then like everything's lining up. That's where I feel that's at right now.
So you still feel like there's plenty of runway left with flex space for
Next
another
3 or
decade
4
or so?
years. Yeah, 3 or 4 years. I think 3 or 4 years. I look a little shorter for something
Three
like
to
that.
four years.
But
Okay.
they're quick turnaround plays, like full development's 2 years. Yeah, and then we're going to the safest markets with the fastest growing. If we know that everyone's moving there, it's the 8 or 9 fastest growing counties in America. They're gonna need storage. They're building 10,000 houses. Well, there's building those big commercial centers. Well, it's just a perfect fit because we know that those people are betting on these huge multi-billion-dollar subdivisions, 3.5 billion in the road in front of us, invested by the state.
Yep.
All that just kind of solidifies, okay, this is the right market because everyone else is putting their money into it.
100%.
That is it's very strategic. Well, we could kind of follow that.
Yeah, makes total sense. Now, when people talk to you and go, "Hey, what are you looking for, Jonathan?" If we're out, on the front lines, talking to sellers, hunting down deals, looking for opportunities, what is an ideal buy box for you guys when it comes to people sourcing opportunities and deals? I know you're a relationship guy, so if you were to, put it out there of what you guys are looking for, what do you tell people?
Yeah, no, that's a great question. I guess if you're working on the parks, I mean, I know it's going to be rare, but uh, for parks, it's usually 50 to 200 units, kind of that range. And then just not turnaround parks, at least 70, 80% occupied. Housing stock, 80 and above, 80s and above. I'm not looking for turnaround. I've done those deals.
Yeah,
Like,
you you
Spark was
you
like
you know the
that.
pain
I'm
that goes
older
along
now.
with
I don't want
those.
to do it anymore. I know it's great return, but I don't want to do that anymore. Um, but then for like the flex space, we're looking for land. Anything with land opportunities, we're looking for right now. I said flex space. We're looking at Texas, our market right now. We might look in Carolinas. We're seeing a lot of growth over there, North and South Carolina. So we've kind of explored that. We don't have the same relationships, so
Mhm.
that could be kind of a play. And so we're creative too. We bring people on team. So if somebody want to be a partner, or maybe we keep key man or something like that, we could
Yep.
work some deals out like that. We're creative on the deal flow, kind of like you mentioned with that's a great asset you got with the park deal. Data centers would be abandoned buildings with the right utility, like the right hookups, power. That's where we're still looking, sourcing family office partners on that. We've got a couple that are really highly interested. So I go to a lot of those family office conferences.
Okay.
So that would be more of a like a bigger building in a major metro. Those would be bigger deals. But so I think most people that listen to us are probably fit in like the land or the mobile home park space, most
Yeah.
likely.
Um, what's minimum or maximum price point that you guys are playing with each asset class?
Sure. For park, it probably 3 million minimum, 3 to 15. It's kind of like the range. And then
Sweet
usually
spot.
that even gets like we put an offer on a deal a couple years ago and we got beat up by institutional investors right in that range.
Yeah.
Um uh, for flex space, any like the land deals, we're looking at a few million. So yeah, like the deal we try to find like off market deals anywhere from like 2 to 4 million, 2 to 5 million for the land, depending on the acreage. And then uh, for the data centers, we haven't come up with that number yet. We're still like doing our due diligence on that, so I can't like give an exact number, but we'll get when we get there. We'll get there. We want to make sure we have our our ducks in a row and the numbers make sense. So we're that one's going to be pretty substantial. I think we're looking $100+ million deals there.
So if I talk to you in 5 years, what do you envision is, what are you going to be telling me you guys are up to and have accomplished over the next 5 years?
Yeah, no, we just with my partner Alex, and he was on it recently. He was like, we just had a call. We always have our weekly calls, twice a week actually, and he was like, "Pro to a billion, really pro to a billion AUM." So that's kind of like our play. So that's our goal for the next like probably 7, 10 years. So
Love it, man. Well, I know a lot of people are going to want to know about you guys, follow the journey, check out what you got going on. If they have a deal or an opportunity, they may want to connect with you on. Where's the best place for them to do that?
perfect. Yeah. So for the mobile home parks, Midwest Park Capital, and then land play. So it's land hyphen play. Um, And or, if they're like digital marketing, like I mentioned that before, is revenuesend.com. But land hyphen play would be most of what we talked about today, or Midwest Star Capital.
Awesome. We'll
Or
be
LinkedIn, Jonathan Tuttle, sorry.
Yeah, yeah. We'll
Some
we'll
people do
be sure
connect on
to
LinkedIn. I
get
always get
all
that
your
every once
stuff
in a while.
linked
Like, I
up in
heard
the
you
show
in this.
notes on the website. So feel free to check out all of the different stuff that Jonathan's got going on. If you want to reach out with him directly on LinkedIn, we'll have that on there as well. Appreciate you coming on the show today, brother.
Yeah, thanks for having me out. It's a great conversation. It's fun. Thank you.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.